Every year, millions of people try to get rich. Sports betting, gambling, day trading, stock picking. Most people lose their money doing that, but some get rich. And I wanted to ask one question myself. What is that one metric that actually decides whether you're gonna get rich or not? And I came up with this conclusion: expected value. Here on the first graph, we can see all those 6 different ways people try to make money, which is horse racing, I didn't mention that as well, and having an information edge, which could let you bet on stocks if you have, for example, insider information. And with these different activities, you can see that most of them, under the hood, no matter how skillful you are, you're under zero, which means you're losing money no matter what, which is roulette. Of course, we're gonna talk about that later, that you can't win money by any strategy in a roulette. Day trading, retail day traders, they lose money. That is the reality. Only the top 5% can actually be profitable, and the top quants in those firms like Renaissance can make for up to 30% annual, but that's less than a percent. That is 0.1%. Of course, skill level matters, and in these 6 different categories, we can see that, for example, day traders, for you to be profitable just past that zero EV, you have to be exceptionally good at day trading. But with other activities, no matter how good you are, you will end up in the negatives. But some of them, they don't even require skills. For example, S&P 500, which is the stock that represents or markets basically the economical state of the world, and no matter how good or bad you are, it consistently returns over 10% annual returns. Similar to S&P, where you invest, you have information edge, and based on those skills, you can bump that up to 30 to 40%. And of course, the top quants in the firms, they are on another level, and they shouldn't be even comparable to retail investors because they're just too good. Also, we have Sharpe ratio, which determines if a strategy is worth pursuing. Basically, the higher it is, the less likely your portfolio overall value to swing. What that means is that if you take a look at S&P 500 bar graph, you will see that it mostly drifts in the upper direction without sudden swings, and it's positive, and it has 0.31 Sharpe ratio, which is profitable. You want it to be positive. Something as an insider could bump that up to 1 of Sharpe ratio, but most of the activities, they under the hood resolve into negatives, meaning they swing rapidly and they swing not into your direction. The activity that most of us try to get rich with is gambling, of course. Now, I picked these 2 ways You could spend your money in a casino, which is roulette and blackjack. With roulette, I have to be honest, there is no strategy. No matter how skillful you are, you can't win because simply of a simple fact. If you bet on a red, you have 47% chance to win, and the house has a 52% chance to win because it's not like there is 50 black holes and 50 red holes. There are 2 green holes as well, which means that in the long term the house has a 5% edge against you, meaning that for every dollar you bet, you lose 5 cents. No strategy can dodge that because actually we can take a look at different strategies, how they perform being dealt multiple hands. We have the famous martingale strategy, which at first glance goes in an upward direction, but after a few plays, a few hands, it goes to zero because the strategy revolves around just betting, increasing your bets after every loss, and basically what that essentially does is if you get into a bigger streak of losses, you can hit that final one, the one that actually wipes out your entire portfolio. Now, blackjack, on the other hand, could have some edge, but it's very minimal. There is a strategy where you can count whether it would be more likely for you to hit or stand. You can essentially have this graph, and this graph shows a slight favor to the player. The distribution around $500 shows you that on the right is a possibility that you end up making profit. On the right of this line and on the left means you lose money. Now in gambling, blackjack and poker, where you have human judgment and skills involved, you can only then find some edge and positive EV. Now horse racing has even bigger negative EV than gambling because the track takes 18% commission from the total pool, from the total prize pool, which means that your EV drops significantly just based on the commission. If we take a look at it on the top right graph, we can see that the higher the track takes of a commission, the more red you're gonna witness to your bank account. Now, with day trading, there are research papers published in 2014 where they basically gathered all the information in Taiwan, and they came up with these conclusions that most of the traders lose their money in the long term. They found out that if a retail trader persists trading over 300 days, they lose money. 90% of them lose money. And to that losing streak, of course, there are many contributions. One of them is the transaction cost. If an operation costs 0.02% a trade, he must be having a big balance, and since he has a lot of money, his transaction costs are lower, and therefore it is easier for him to operate and to turn profitable. Now, retail, of course, he doesn't have such a big bank balance, and so he relies on higher fees, and therefore these higher fees contribute to a bigger loss over time. Now, in the short term, you may think that you could be profitable. A path you're walking seems well, but if you take a look at it, the shorter you play it, the more luck you can get. But with the large numbers theory, if you play the game long enough, that is not in your favor. If you don't have the necessary skills for it, you will go down, and you will go down hard. And the average retail, as we can see, goes in a downhill direction, and only the few can actually make money. And those few, they don't even make that much profits. As you can see, their EV is around 0.6, 0.7, which is, I would say, higher than S&P 500, but if you really think about it, S&P 500 does not require any skill. Where trading, you have to be exceptionally good to actually make money, to manage bigger amounts, which is of course difficult. How do traders or investors do make money though? That's the big question, and usually we can explain it with having an information edge. For example, you are a CEO of a company and you know how it works, the internals, the reports, and they're not public yet. The market doesn't know how the company is doing this quarter, and the stock doesn't reflect that. Therefore, you can put a bet on your company, you can buy some stocks. You have to legally state this with a document, official document, so it's not illegal. But if you actually publicly buy your stocks, before publicly disclosing the internal information that could affect the stock price, you could make a lot of money. And depending on the information quality and its impact, you can drastically improve the benchmark from which the S&P 500 operates. And of course, if you are working in a company, there are limits to which you can use that edge, because it is actually illegal to trade having material non-public information, and the SEC can trace you down. How they do that? They basically trace who works in that company, their friends. They take a look at disclosing pre-market trading activities. They trace down those people, they trace down their friends, take a look at who works in a company, and when everything is baked into internet, you can easily trace sources of information, sources of action, and to a certain point that trading is illegal, but if you do it legally, you can basically beat the S&P 500 and make some nice money. Now, speaking of edge, I will still try to find it. I will pursue it, and eventually, I will get there. But for now, in this talk, at least we have covered where not to put your money.